live trading room, live streaming from TicketTacker. We have a pretty quiet opening here this morning. Taking a look at the gold market, 1728.40, up about 340. It's been pretty much all over the place this morning. Copper is up about 6-7 cents for 4.56. And the derivative markets are fairly quiet this morning with an upward bias. The metals derivatives. GBTC is up about 120. We've picked up what appears to be a bullish pattern here unfolding on GBTC from the buy one level, basically daily, and also from the weekly average price of 43.04. The upper end of the target is 48.05, 48.10 to all the way up to the sell-to level of 52.39 for the rest of the day, and also for the rest of this week. As we complete this week pattern, then we're going to be moving into the next weekly pattern here over the weekend, and we will be publishing the information for next week as well over the weekend. Just a couple of notes, noteworthy couple of news that are, I believe, of some kind of a major importance in the whole scheme of things. And there is a blockage in the Suez Canal, which could cause problems for the globe. The massive cargo ship Ever Given has completely blocked the Suez Canal, a vital trade passageway for as much as 12% of the world's seaborne trade. I think if you go back and take a look at some of the videos that I've done live streaming for the past few months, one of the things that I believe was beginning to develop was the potential for a shortage of supplies, and this was even before this blockage in the Suez Canal, which is the main distribution area of commodity supply to the world, North and South America, and to the world. So here's another element to deal with on top of everything else that we're dealing with from you might say, a logistical point of view with regards to the availability of supplies as we come into what it's called this new normal economy. And I think that one of the things I'm alerting my clients, my traders in my private trading room, is that you got to prepare yourself for what could be runaway inflation. I know it doesn't show on any of the formulas that are used by the government. The CPI does not include food and transportation. And I think we have to pretty much go back to, if you go back to the formula that was used back in the 70s when the CPI included food and energy prices. We're looking at a runaway level of inflation that could exceed 10%. Now, if we exasperate this situation with a supply problem, it's only going to essentially cause prices to skyrocket. I mean, it's just the way, Economics 101 works based on supply and demand. If demand is greater than supply, as it applies to our economy and products, the price is going to be reflected in the price, obviously. And more demand than the supply, obviously, you're going to get prices to reach an economic level that it will basically balance that anomaly and bring it to an equilibrium. So I personally am preparing for an acceleration of price increases. That's the only thing that we haven't seen in the economy is basically price increase inflation. Although we have seen asset increase inflation, certainly in stocks, in the real estate markets, in collectibles, and now in virtual art, that essentially is a series of codes that somebody was willing to pay up to $62 million. So obviously, you can see the intrinsic value is moving and searching for alternatives against this potential, you might say, black swan that could unfold called inflation. Now, the anomaly that we have right now, if we take a look at, for example, the 10-year note, the 10-year note has reverted back up in yield. It's at 166.40, up about 5 basis points, up 3.07%. And this is coming in on top of a potential supply problem, a supply squeeze that we have building now as a consequence of this blockage in the Suez Canal. But it's just, I believe, the straw that could break the camel's back, in that this could be, you might say, we'll see how the markets react to basically putting in a major bottom in precious metals. And why is that? Well, the anomaly that we have in rising interest rates, particularly on the 10-year note, is in anticipation or potentially trying to price in the fear that inflation may be unfolding down the line. And government bonds, treasury bonds, are at huge risk if interest rates do snap back up. The debt, the U.S. debt, is at risk. The cost of that debt is at risk. The increase in the cost of the debt throws an anomaly in the rest of the economy, because of the expenditures have to be focused on maintaining the debt. And the bottom line is that we have spent close to $30 billion in this economy to support we have spent $30 trillion to support a $20 trillion economy. It just doesn't make sense. So the I believe path of least resistance that the market is building is a potentially volatile precious metals markets as it begins to price in the potential danger that all of this stimulus, all of this liquidity, all of this free money is going to have into the system. I think what the leaders, our economic leaders, are expecting is that this money is going to come back into the economy to revive the economy. But what if we go back into an economy that is short of supplies to meet the demand, as we're beginning to see? And I don't know, we have yet to see in, if you take a look at durable goods, for example, which is a good measure of demand of the supply chain, it has collapsed to 1.1% from an expected 0.4%. That's a minus 1.1%. Where is the economy growing? Is what throws me off. You have all this politicians, leaders coming out and just we got a great economy. We're going to be growing GDP faster than pre-pandemic, and all of this ridiculous comments that are made that are not based on sound facts. So being around for a little while, what I believe is happening here is that all of this fundamentals that are building underneath this precious metals markets that I'm focused on right now primarily could be extremely explosive. The monetary system, the US dollar is being challenged right now by this pandemic. In how can we get through this pandemic on the other side without causing massive inflation, without causing interest rates to go up? Well, it's called yield curve control coming up. Prepare yourself for the Feds to implement yield curve control, which means that they will cap the rise on interest rates on the long-term bond, where most of the debt has been accumulated. And so the bond market, the 30-year bond market, is really at risk if interest rates do turn around to the upside. Just calculate 1% on a $30 billion debt, what it represents to the economy. Our expenditures are becoming greater in maintaining the debt than the economy, which is not sustainable. And so as a trader, I see an incredible opportunity, as frustrating as we're looking at this market, coming down on the face of what appears to be the potential not only of inflation coming back, but a shortage of supplies on top of it, with possibly higher rates. Yes, I think that what we're going to see here is a mirror image of what happened in the 70s, when interest rates shot up to 15% in 1981. And, right after Nixon lifted the gold standard, the dollar collapsed during that time against gold, and inflation went to 15% until we got some of the big muscles to come in and basically, with the Reagan administration and Volcker, began to put pressure on interest rates, and interest rates began to collapse after that. But the level of inflation exploded. If you go back and you look at the records, interest rates went up simultaneously, and the price of gold went from roughly $100 around there to over $850 an ounce. So the interpretation, or the misconception, I would say, of people that think that a rise in interest rates is bearish for precious metals, I think is wrongly interpreted with these fundamentals that we're dealing with right now. Particularly, as I said, with interest rates near 0%, the debt at record levels, and a pandemic that essentially is causing massive supply disruptions. If you just look at those details individually, it doesn't bode well for a healthy economy. And so I am taking the responsibility in using these markets to monetize for myself, my friends, my family, for my subscriber base, for you, fellow traders that are coming in here and watching this and are wondering, what the hell is he talking about? What I'm talking about is the fundamental picture is completely distorted, and it's very difficult to trade fundamentally. The precious metals markets in particular are not reacting to the fundamentals yet, particularly when you hear and you talk about shortage of supplies, gold, silver, shortage. And so the market, the real market, which is the cash market, has separated itself from the paper market, which is what we're looking at, which is what we're trading here. The futures contract and its derivatives, shares, ETFs, leaps, options, whatever, is a derivative of the metal sector. And so I'm using the daily structure that is produced by the VCPMI to trade the market for day trading. And so taking into consideration all of those fundamentals that I just went over, how do you make money? Well, first of all, you want to be careful not to follow the herd. It's very simple. In other words, do your research. Don't just follow somebody's recommendation without at least feeling comfortable that you have done some research. And you can Google everything right now and find just about every answer that you can. You can educate yourself literally for free. The one thing that you're not going to find in the internet is the proprietary algorithm that we run, which is called the variable changing price momentum indicator. That gives you the a very specific structure. If we can put those fundamentals aside and we can focus on the way that I trade, basically, is by selecting, obviously, a market that encompasses all of those fundamentals internally. Obviously, the gold market, the silver market, platinum, palladium are precious metals that are affected by what happens in the economy, in the monetary system. And so not only you can trade these instruments as a commodity, you might say, but also they are becoming affected more and more because of its fundamentals unfolding, because of the future or the potential of where we go in economically speaking. It's not just a matter of if, as much as when this will happen. You can only suppress a market for so long that the physics is such that the longer that you suppress the natural flow of price and energy, the longer you skew its actual process of reverting to its mean. And so the longer you suppress, it begins to build pressure, price pressure that needs to release and find its mean. And, in gold, if we focus why in gold, for example, we have seen an incredible amount of manipulation in the gold market pretty much since 2012. But, more recently, we've taken a look at gold here, the daily chart. The high was 2089, and we've seen this consolidation phase, this corrective phase, come down to test 61.8% Fibonacci retracement in a potentially shortage of supply market. $300 correction on 600 plus leg that we saw, which was the first leg. From March 1576 low to that 2089 high. Well, that's a $500 move from April 1st. More than $500. So for myself, just like everybody else that understands the dynamics of these fundamentals are looking to do, is to acquire precious metals assets. But it's been frustrating because, again, we've seen this attack of price without justifying the supplies. Some of these sellers here that essentially central banks, they come in here and they sell 10 to 1 in the futures markets. They sell 10 to 1 supply. Which is, I believe, unethical. And this is how they maintain the lid, or the price, you might say, suppressed in what really is becoming one of the most inexpensive assets to own in the world, and that's money. That's real money. Money is at a discount. Real money is at a discount in comparison to fiat currency. Silver, 25.02 an ounce, and that's real money. This price is not going to last very long. It is the most undervalued asset in the world. And so I am focusing more now on silver, because I think, first of all, it's not as liquid as gold, and therefore you can see greater volatility in silver than gold. And the profit potential, I believe, when you just take a look at the value of gold to silver, the ratio is completely out of whack. We saw the ratio, the gold and silver ratio, got up to about 120. And we're trading in the 60s. The long-term spread relationship is 9-to-1 in terms of production. 9 ounces of silver to 1 ounce of gold. And we're looking at 60-to-1. So the most undervalued asset that we're looking at is silver. And from here on, I am looking to buy silver on any corrections from here on and add to the silver position. The gold and silver ratio is running roughly at about 69. So silver definitely is indicating to be undervalued to the price of gold. We got a very quiet market this morning. The market is trading around the average. There's not that much activity, as you can see. So I'm spending a little more time here talking, but there actually is no signals. The market is in a bullish, a neutral to bullish zone in silver. And gold has completed that 1730 target once again, which is the average, the daily average price. And the weekly signal, which it came in last night actually at about 4:30 a.m. We've seen a lot of volatility here. You can see trading in silver between the averages and the weekly B1. So you can identify right away with this pivots here where the market is trading, in relation to its probability factors, and we can see the price, ranges 1722 to 1730. So anytime it comes down, to 1722, you're going to get buyers because it's in the blue area again that I review. The artificial intelligence identifies. So we been trading back and forth, from 12 p.m. back down to the mean at 8 p.m. back up to its target again, coming back down. You see, and it's trading within that range, within that trading range, like It was made for each other. And so I respect the probability model mathematically that it gives me, in that the market itself is what validates the credibility of the algorithm. The market resolution to its levels identified is what validates the algorithm to be of a high probability. When you get a short, you complete the pattern regardless of the level. When it closes below, it's a bearish trend momentum. It activates a bearish trigger, and the target automatically is the levels below. In this case, the weekly level of 1722 was close enough. The market met the target at 8 o'clock, traded there for a bit, and at 8:45 activated a buy trigger that once again met the target from 8:45 p.m. to 2:45 a.m. And it's during the Globex. Once again, all this action that you see here is during the Globex. So if you were up during the Globex, and you could trade this markets very successfully. As you can see, the last signal here was activated at 4:30 a.m. on a close above 1722.50. Your stop automatically is the level below. You can measure your risk using 3 different levels of stops, and the target was completed again. So this is the 1, 2, 3 tries that we basically have challenged this level of 1730. And we also have identified where the buyers are underneath the market. And so with this kind of action, for example, as a trader, for me, it identifies where the supply and demand is being traded. The price is a consequence of identifying the probability levels of energy in the market. So when the price comes down to buy 1 here, and it tests this level, it completes the previous pattern, and then it reverts. That's the trigger point. That's where you go long. You go long, you put your stop below, 3 choices, and your target automatically is above. It's completed. So you're neutral here from this signal. And the market coming down on this bar is activating a bearish trend momentum again from the average price, which tells you rest. Don't trade the average now. You don't need to be trading back and forth here on the average. The average is 50-50 standard deviation. So what you want to do is wait for the highest probability trades, and that is for the market to either come down again to that 1722 or to close above the average and activate a bullish price trend momentum with the targets of 1740 to 1738. So we don't need to get chopped up around the average. What we want to trade is the extreme above that mean or the extreme below that mean. So the VCPMI is a very perfect Fibonacci structure of 5 pivot levels. And within those 5 pivot levels, it identifies the average price. Once we identify the average price, then we can extrapolate mathematically the probabilities above that average price for the sell 1, sell 2 levels. Same thing for the extreme below the mean. So the algorithm has pretty much built in within this simplistic structure a complex number of various different technical analysis indicators. they're integrated within the algorithm. And what I'm teaching you here, my friends, is the artificial intelligence that was written in C++, easy language, in TradeStation. Let's just continue to watch the market here. Today is pretty quiet around the board, all over the board. It's pretty quiet. The E-mini S&P picked up a buy trigger from the B2 level weekly here, and it has completed the pattern of this weekly buy trigger. Pretty much you see this, all the signals above, all the targets above have been completed. And now we're trading above the weekly average, and 39.30 is the next target. But it is approaching a high probability area of distribution of supply. Now, the structure is the same when we're day trading, and the structure follows the same procedure for the weekly signals. So we can incorporate the daily and the weekly signals and look for the harmonic relationship between those signals. So you can see here in the E-mini as well, anything above 39.30 all the way up to 40.20 is a level of resistance that is telling you that it's a low probability to buy the market up here, as much as the short signals will have higher probabilities of success. We're waiting for the expiration of the options for the month of March. The contracts in futures are expiring, going off the board here as we come into next week. And so we are at the beginning of another seasonal trend unfolding. And we're at the bottom of the extreme below the mean. So you want to buy these corrections. And depending upon, again, your objective in your account and your profile, it's giving you an opportunity not only to day trade the market, but also to swing and to position yourself over the long term. Copper is picking up a bit here at 405. It's trading above the $4 level once again, but it is in a level of resistance, and it's recommending to take profits here if you're long on the copper. When the price comes down to the average, as it did here in silver, it basically is completing the previous pattern and activating a new trend alert and closing above the average basically is igniting the bullish trend momentum once again. And this is on silver from the average price. When the signal is activated, automatically the target above is also activated. In this case, 25.45. So a close about 24.94 is going to bring us a buy trigger, and the target is 25.45. This identifies the trend momentum for the market, the average price. The average price is a 50-50 standard deviation, so it can get choppy if you trade around there. So you need to be more active in using your stops if you decide to trade there. I choose to trade the extreme above or the extreme below in terms of day trading, and use those extremes below, for example, when I do get them, to add to my long-term position. The key level to watch in gold is 1738. A close above 1738, 1740, I think, is going to be very constructive for the acceleration of this momentum to the upside. Very quiet. Very quiet sessions with an upward bias. So all we need is to just be patient here. There's not much going on anywhere else. Very quiet across the board. Nugget has activated the buy trigger from the buy one level. These are the derivatives that we track that we're buying long term, but we are trading these instruments. You want to, if you want to be aggressive in trading this market without margin calls, you may want to take a look at Nugget, JNUG, which are bullish ETFs, and we also use Dust, which is a bearish ETF, and you can comfortably trade aggressively by trading the long side of these ETFs and using Dust if you wanted to hedge, let's say, your position without getting out. So the derivative markets in gold and metals, I would say, give you an incredible flexibility for you to manage your risk, separately than just using margin in the futures contracts. For those that want to expand, you might say, trading the market a little more diversified, particularly when we expect some kind of reversion to unfold. What happens is most of this activity occurs at night in the Globex when the markets are closed and the U.S. session is closed, and it doesn't allow anybody to get in during the day session. So it opens up in huge gaps. And one of the things that I am preparing for by taking a core position, and this is what I've recommended to my subscribers, my traders here, that you want to trade the market in futures short term to generate liquidity, and any profitable trades that you make, for example, day trading the market, you reinvest them on a longer term strategy that you can continue to trade the market with the same direction. So, if you make a few $1,000s on a day trade, take that few $1,000s and put it into an asset that is of a longer term duration without margin. This is how you can build a long-term portfolio, and ideally, build it with the market's money. Let the market finance your trades. Manage the risk differently, diversify the risk between day trading, swing trading, and even position trading. Because when this market goes, more than likely it will be overnight. More than likely it will not allow you to participate, either because of the hours that it's traded in, or because the exchanges are going to raise margins. And this is how they controlled in the futures contract. And you want to be aware that when you're holding a position overnight, you're subject to the exchanges increasing or changing the margin requirements anytime. And so this is how the exchange regulates these runaway markets, particularly in the silver market, is literally by raising the margins and making it impossible for people to trade, common people, regular traders. And this is where I think we're beginning to see this new player, Wall Street Bets, Reddit, Robinhood, so to speak, making it available for the little guy, for the small trader with $100 or $200 to go in and buy the market. And it's a new player that, it's the small player, it's the small retail account. that have found a way pretty much to trade the market on a blockchain kind of basis, on a block basis, where you get the majority of this little buyer, so to speak, put in a major order that could impact the market, as it did in GameStop, as it did in AMC, as it did in in some of these other heavily shorted stocks that we've been talking about for the past few months. So I think it's the beginning of a new player that I think we're going to have to deal with in this market, and it's another liquidity form. The thing that I see is pretty much the massacre that occurred from these young traders that came in here, obviously thinking that they could squeeze the market. And to a certain degree, they succeeded very short term in doing it. They woke up the short predators to the possibility that they got to deal with this new player in the market. And they did some damage to this short predators, these hedge funds that were heavily shorted some of the stocks. I think with silver and gold, we're dealing with a bigger picture. We're dealing with bigger players. And primarily, you're dealing with central banks that take the other side of the short side of the paper market. Ever since they eliminated the uptick rule in 2011, we have seen predator algorithmic selling by the central banks. And it's pretty obvious how they contain the prices and force, people to get out of the market by basically manipulating the price and getting them to hit the stops that people use for protection. And once they clean those stops, and the market reverts back up to its equilibrium, back up to its average price. And that is the methodology that the VCPMI looks to trade, you see. The VCPMI is a contrarian indicator, understanding that everybody is following the same sentiment. What the VCPMI looks to do is identify that sentiment, and when it is at its extreme, above or below that average price, then it identifies where the value is. And that's what we look for, is where the value is above or below the average price. It's economics 101. Never mind about all these other complicated, sophisticated methodologies that can only confuse you or a young trader, after so many years of being in this business, what I've come to conclude is that making money is not really that difficult if you get out of the way. The most determining factor in all of this is you, is me, us, ourselves. We are our worst enemies. And so understanding that aspect of my trading here I choose to put my emotions on hold and use the VCPMI as a guiding tool for me. That is telling me right now we are going through the average price and it's activating a bullish price momentum, and automatically the targets of 1738 to 1740 are activated. It's clear as a whistle. There's no ambiguity. There's no tracking. There's no, it's pretty clear cut. The market earlier came down to 24.42 at 5:45 a.m. on the 25th, activated a buy trigger, as you see on this bar here. It completed the target above, and it activated the weekly target of 25.42 and also the daily targets of 25.39. You can see the market trading below the weekly B2 level is completely oversold. The market is trading above the daily average, so it activated a bullish trend momentum. Your stop is 24.94, your protective level. Your targets are 25.39 to 25.42. Once again, ladies and gentlemen, thank you for the pleasure of sharing this incredible information with you. And I truly, sincerely hope that you are taking advantage of this situation, that you're turning this opportunity for your benefit, and that every day you come here, you get to become a better trader. Have a great weekend. Be safe, and I will talk to you on Monday. Take care.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.